and welcome to V-Guard Industries conference call to discuss the Q2 FY19 results. To discuss the results, we have on the call Mr. Mithun Chittilapilli, who is the Managing Director, Mr. Ramchandran, Director and Chief Operating Officer, and Mr. Sudarshan Kasturi, Chief Financial Officer of the company. May I now request the management to take us through the financial highlights and subsequent to which we can open the floor for Q&A session. Over to you, Mr. Mithun. Thank you.
Thank you, Achal. A very warm welcome to everyone present, and thank you very much for joining us today to discuss the operating and financial performance of our company for the second quarter and half year ended 30th September 2018. Net revenue from operations for the quarter ended 30th September 2018 stood at 598 crore. Revenue growth during Q2 FY19 at 6% was impacted by some quarter-specific event. Floods in Kerala slowed down the seasonal demand around Onam. A weak summer condition in parts of the country also resulted in low offtake of some of our products. And high base of last year due to GST rollout and related recovery in Q2 FY18. As per our assessment, growth impact estimated from Kerala floods has been to the tune of about 25 crore, excluding which overall revenue growth of 10% may have been achieved during Q2. Growth was driven by digital UPS, kitchen appliances, water heaters, wires and wiring accessory segments, which reported growth of 13.6, 23.7, 11.3, 8.3 and 48.8% respectively. A weak summer adversely impacted growth in stabilizer and pump categories, which declined 12.6% and 3.8% respectively. Non-South markets recorded robust growth of 16% YOY in Q2 FY19 as we increased our penetration and roll out new products in these regions. Non-South contribution increased to 35.7% of sales in Q2 FY19 from 32.5% in Q2 FY18. South markets were muted on the back of Kerala floods, recording a growth of only 1% in Q2 FY19. During the quarter, we extended gas stoves to be launched in Tamil Nadu as well. Gross profit for the quarter was lower by 1.8% to 177 crore in Q2 FY19. Reported gross margins were lower by 230 bps YOY and 80 bps QOQ. EBITDA margins were impacted by the top line loss and stood at 9% in Q2 FY19 as compared to 12.3% in Q2 FY18. Margins saw transitionary impact caused by volatility in commodity prices and the depreciation of the rupee, both of which have a bearing on our raw material prices. PAT declined 17.9% YOY to 38 crore for 38 crore. For the half year, EBITDA at 103 crore was flat, while PAT 73 crore grew 5% as compared to H1 of the previous year. Cash flow from operations was robust to the tune of 134 crore in H1 FY19 as compared to 67 crore in H1 FY18. We have been able to drive a 5-day YOY improvement in our working capital cycle to 59 days. In addition, our balance sheet continues to be robust with a net cash of 155 crore as on 30th September 2018, providing a war chest for future growth opportunities. Our return ratios continue to be strong despite the significant investments made in brand building over the last few quarters, with ROE and ROCE of 17% and 20.1% respectively on a TTM basis in Q2 FY19. Overall, we have continued to invest in people, brand, product development and organizational competencies that we see bearing long-term results in the business. We continue to make good progress in the non-South markets and we plan to extend our new products into some non-South markets in the second half of the year. Despite the impact in Q2 on a YTD basis, the like-to-like growth has been a healthy 12%. We are hopeful of recovering a part of the top-line growth in the coming months. We also plan some pricing action which will help recover the impact of the input cost increases. We maintain our like-to-like growth of 15% forecast for the remainder of the year and over the next few years. On that note, I would like to thank you once again for your participation and would like to hand over the floor to the moderator for Q&A. Thank you.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may please press star, then 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star, then 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask a question, please press star, then 1. The first question is from the line of Nitin Arora from Axis Mutual Fund. Please go ahead.
Hi, Nitin. Good afternoon. My first question is that when you look at the growth which you're talking about, at 15% in the second half of the year, versus if you look at the base, not the Q3, which has a very high base of revenue, it's still about on an average is 14% if you look at the second half of the previous financial year. Which categories you are thinking? Because in the south, it looks like that, the festive season itself is a little bit gone by because of these floods, especially the Onam. So, is there something that non-south is going to be growing much faster than the 16% growth, which will drive for you the overall growth of 15% in the second half? Or you think like for a category like a pump, which eventually has declined in this quarter, but this is something where we were expecting that, because of the flood, pumps would start growing a little faster. So need a clarity on that, on the growth aspect. And number two, if in the second half, a non-south is going to grow much faster, then the pricing difference, or let's say the entry-level products between what we have in the south versus non-south is pretty different. Also the pricing part as such. I would not say pricing, but the entry-level products. So will that really impact margin, or you think margins get normalized at 9.5%, 9.8% in the second half? Those two aspects is one.
So, see, how we see the 6 months, our like-to-like growth has been about 12%. So, if you have to maintain a 15% growth, we have to grow, slightly ahead of 15% for the next 6 months. Two things will happen. One is that some of the sales lost during Q2 will be made up in Q3, especially in Kerala, as the rebuilding activities gather space. That is one. The second part is also that last year our Q4 growth was impacted because we had a very late, or very late arrival of summer, and summer sales had not picked up at all last year. And in fact, it continued all the way to Q1 this year also, where we had a very poor performance in the summer-based products. So we are expecting all summer-based products, starting with air conditioner stabilizers, pumps, fans, new launches like air coolers, all of them to do much better than what they did last year in Q4. So big part of the growth we are expecting in Q4 to come, and some part of the growth will also happen in Q3 because we see some postponement of sales happening from, especially in Kerala, from Q2 to Q3.
And what about the margins? If your non-south remains still a faster growth, not the mix, but the faster growth in the south?
So margins, if you look at last year, our H1 margins were very good and H2 margins were very weak. This year we are expecting a reversal because a lot of the pricing actions which are undertaken in the current year will start reflecting only in H2. That is one. We also believe that further, huge increase in commodity prices is not expected. I think we have reached a level where I think the commodity prices are reached the peak, and many of these things have already been priced in. So I think once the pricing actions are undertaken, the margins should also, restore to earlier levels. I think we are expecting about 10% EBITDA margins for the full year.
Thank you, Nitin. I'll come back in the queue. Thanks a lot.
Thank you. The next question is from the line of Aditya Bhartiya from Investec. Please go ahead.
Hi, good afternoon, Mithun. Mithun, my first question is on price hikes. Have you already taken some price hikes to account for raw material costs and rupee depreciation? And if yes, then how has been the response for trade channel, and have your competitors also reacted in a similar way?
So obviously our competitors are not, has been very quick in passing these hikes into the market, and that's why we are also having a margin erosion. So obviously the demand environment is not so strong that competitors are increasing it very fast. But having said that, the quantum of price increases that need to be taken are fairly large. So I do believe that many companies will eventually resort to price increases. Some products like summer-based products, we are right now in the off-season, so price increases may happen only in the month of January or February, but definitely they will need to happen. And something like wires, immediately the price increase or decrease is passed on to the market, but in other categories, maybe once in 6 months only prices are revised. So I think, as of where we stand today, many competitors have not increased prices, but there are some signal that they will also be increasing because the quantum of increase is fairly large.
And given the large quantum, are you confident that the complete impact can be passed on to the channel?
So I think the only way to look at it is what has happened earlier in the earlier years when we had such a big increase in commodity price. What has happened, and where we also had big depreciation in rupee also, what has happened. So in most of these instances in the last 7-8 years also, when this has happened, this is probably third or fourth time this is happening in the last 7-8 years. The industry has finally passed on the prices to the market. There may be a 1 quarter delay, but usually not more than that.
Okay. And you mentioned about 10% EBITDA margins for FY19. Given that we've had around 8% EBITDA margin in first half of the year, that kind of bakes in a fairly strong second half. And especially in the context of cost inflation that we are speaking about, what do you think would be contributing to such a sharp increase?
See, one thing is, like I said, many of the pricing actions which are supposed to be undertaken in Q2 has not happened, so that has to happen. Second is that our, stabilizer as a category has, degrown in the first 6 months. So I think in the next 6 months they will continue to grow, and the mix itself will improve to a better product mix. So both these factors should improve margins in the next 6 months.
But 11% plus kind of a margin is something that you're expecting for second half?
I think, around 11% we should hit. Yeah.
Okay. And so my last question is on margin differential, both at the gross margin level and at the EBITDA margin level between South and non-South. If you could give us some indication as to how the two are behaving.
Non-South margin is about 2% lower than South.
That's at the gross margin level?
Gross margin level.
And at the EBITDA margin, sir, how much is the overhead differential?
See, the EBITDA margins, if you look at non-South, for the first 6 months of the current year is about 4%. 4% EBITDA. And last year, for 6 months would have been about 3.2%. And the South EBITDA would be about 11.5% for the first 6 months for this year. So, South and non-South, South is about 11.5% and non-South is about 4% EBITDA for the first 6 months.
Understood. Great. Thanks a lot, sir.
Thank you. A reminder to the participants, to ask a question, please press star, then 1. The next question is from the line of Sonali Salgaonkar from Jefferies. Please go ahead.
So thank you for the opportunity. So my question is again on your margin estimate of 10% for the full year. So you mentioned that much of it will come from pricing action that you would take in H2 FY19. So could you approximately quantify as to what kind of pricing action you are about to take?
See, the raw material prices have increased anywhere between 3 to 6% in various categories, and something like wires probably even more, maybe 10 to 11%. So definitely some pricing increases have already been initiated in the market, in Q4 of last year. But definitely we need to increase more prices as, commodity prices have again increased. So in that sense, around 2 to 3% price increases. So this will vary on an average between category to category, but 2 to 3% price increases will have to be taken across. The margin improvement will not only happen due to pricing increase, but generally more favorable product mix as we go into H2. Because in H1, all the summer based products like stabilizers had performed very badly because of poor summer and all that. So if you are having a reasonable, next 6 months of sales for those categories, the general product mix also will move to a more favorable margin.
Sure. So my second question is on the festive season right now. So, I mean, what kind of feedback are you getting from on the ground, particularly now that Navratris are after us and we are just about a week and a half to go for Diwali?
So, this is Ramchandran here. There is not a particularly, I would say favorable or unfavorable feedback that is coming. The sales tempo is okay. So, I think, maybe, I would say that, even a bit positive in terms of, whatever selling in that we have observed in the last 20-25 days. Yeah. So tempo is okay, but I wouldn't say that it is particularly bullish or particularly bearish.
Sure. So my last question is, what kind of volume growth have we seen in cables and wires this time?
So if you look at H1, H1 we have had a volume growth of about 10%. Sorry, volume growth of 6.2%. Sorry, value growth is 10%.
Sure. Thank you, sir. That's it from my side.
Thank you. The next question is from the line of Karan Patel from Synconic. Please go ahead.
Yeah, hi. Thanks for giving me this opportunity. My question is to Mithun, as in, what do you identify as the operational focus points and sources of risk in the coming quarters?
See, I think as far as we are concerned, we have had a very unfavorable, raw material price environment in the last 12 months. So a lot of the actions have been on to, for cost rationalization in various categories, various initiative actions to reduce cost of products, etc. So that has been one focus. The second is also has been on preparing, some new categories for launch. So we have, very excited to launch modular switches. We have already launched in one market in South India, and we are looking forward to launching it in other markets. So that's also been one more, some of the new category launches have also been one of the things we've been focusing on. Air cooler is another category we've launched at the fag end of last financial year, so which will see a lot of increased investments and launches in the current year. So these are the two, things that we've been focusing on.
Okay. Yeah, and what about any sources of risk?
So I think we have plenty of risks. We have a risk of currency, we have a risk of raw materials. We also now have probably a risk of liquidity for retailers, which probably would have been financed by NBFCs. So we have a lot of these things have already there. Maybe the liquidity risk is something fairly new. The rest have been all been there playing out in the last 6 months.
Okay. Yeah. Thanks a lot.
Thank you. The next question is from the line of Bhargav Buddhadev from Ambit Capital. Please go ahead.
Yeah, good afternoon team, and thank you for the opportunity. So the first question is, in terms of cash conversion cycle, there has been a remarkable improvement. However, the same has been primarily contributed by the increase in the creditor days. In terms of reduction in inventory days, we've not seen much improvement, though we've conducted supply chain improvement initiatives like Project Page. Can we going forward see some improvement on the inventory days on the back of those programs which we've conducted?
See, I think the inventories have not reduced as much as we would have liked, partially because two reasons. One is that, a very soft summer meant we were carrying higher inventories of stabilizers and pumps. And not only we were carrying, our channel was also carrying, so our selling in Q2 also has been very weak for these two categories. The second has been on account of Kerala floods. We had stocked up for a kind of sales in Kerala for Onam, but like we mentioned, we had not, that sales have not materialized. So obviously that is also sitting in the, our inventory. So I think the inventories will correct. If you look at inventory days, we are at 68 days this year, vis-a-vis 64 days last year. So ideally, we would have liked to go below last year's, inventory days. We are, however, happy to say that debtor days we have reduced from June. So sequentially, we have had a 3-day reduction in debtors. I think by I think either December end, we should start seeing better inventory days as the, as the inventory corrects, or maybe we are moving into season, so maybe March end, maybe we will see a much more lower inventory days, because December end also we may still carry some inventory for, upcoming summer season. So one of the reasons has been the, poor summer, and the second reason has been the floods, which has both contributed to higher inventory.
Sure. Secondly, sir, on the fan side, the growth has been on the weaker side. Is this because we have a very high exposure of fans from Kerala or in South India?
Yeah, so primarily we do have, we do have a high percentage of sales of fans coming from Kerala, maybe something like 30% or something is coming from Kerala. So that is there. And Onam is fairly brisk selling season for us for fans in Kerala. So that has definitely contributed to this. We also had some issues as we were not having inventory in some categories like TPW, that is table pedestal and wall fans, which got delayed, because of delayed imports. So that is also one of the reasons, but it's primarily because of the Kerala impact.
In the rest of the market is fine. Non-South grew by 30% plus. So, and in fact, on first half, on a like-to-like fans has grown 22%.
Okay, fair enough. And lastly, sir, in terms of Kerala, are you seeing demand through restocking coming back, and essentially can we expect the 25 crore revenue loss which happened in 2Q to be recouped in the second half?
We are expecting, most of it to be recouped in the next 6 months. So definitely we are hoping for that. There will also be some rebuilding activities that have slowly started to be initiated, which will also drive demand. So I think a large part of the demand should come back is what we see.
Okay, sir. Thank you and all the very best.
Thank you. The next question is from the line of Charanjit Singh from DSP Mutual Fund. Please go ahead.
Hello, sir. Good afternoon. Hello.
Yes, please go ahead.
Yeah. So if you look at the water heater segment, there we are seeing, new player like Crompton getting very aggressive, and even we are hearing that Havels has been very aggressive now in the southern market. So this price hike, wouldn't be very difficult, in certain categories which where we are seeing this intensified competition or the new entrants getting very aggressive.
So obviously, water heater is one of the categories where there has been a lot of new entrants, a lot of players from sanitary, and a lot of Chinese players. A lot of them have entered, including existing peers. So it's not a new thing. It's been going on for the last 3 to 4 years. It's something that we are used to. But having said that, the quantum of price increases or the raw material price increases is fairly high. So we have also started to see players, preparing for price hikes. So we have still grown by about 14% in the first quarter and 14% in the first quarter and second quarter also we have grown by 14% on a very large base. So I think we are doing okay as far as competition is concerned. So hyper competition is nothing new for us in almost all categories where we have everyone trying to get into each other's category. And this has been going for the last 4-5 years. It's not something very new.
Okay, sir. So if you can highlight also about now the switchgear segment, how is that expected to now pan out going forward, and on the modular switches also we have launched new products.
So the switchgear business is doing extremely well. We have done close to trying to get the numbers.
37 crores.
Yeah, we've done close to we've done close to 38 crores of revenues from the switchgears and modular switches. Switchgear is still the bulk of revenues, and modular switches is fairly new launch. We are hoping to close this year with about 80-90 crores of wiring accessories business. About 80% of them will be 70% of them will be switchgears, and 30% will be about modular switches. So both have been doing well, and they have got good traction. Modular switches is also doing extremely well. We have very limited SKUs what we have launched, and even with that single range and single market, we are doing well. So we are quite bullish on launching it in other markets as well.
And so the last question on my side is regarding the ad spending going forward. How we should see the trajectory? What was the number in this quarter? And
so for the full year, you can assume an A&P spend of about 4%, which is the kind of spending we did a couple of years back. Last year, our A&P spend had gone to about 6%. That's because of the brand relaunch and all that. So for the quarter, it's about 4.6%, but I think for the year, maybe close to 4% is the A&P spend that we are expecting.
Okay, sir. Fine, sir. Thank you, sir. That's all from my side.
Thank you. The next question is from the line of Krishna Prasad from Go Frugal. Please go ahead.
Sir, good afternoon. Sir, I just want to understand about the strategy in the consumer durable segment. Primarily, the general market sense is that the margins are higher in the category, so there will be initial advertising and branding cost. But I see that air coolers, the current quarter, there is no sales. And some of the other categories also, what kind of growth you are expecting in that category?
So in the consumer durable segment, we have two large categories as water heaters and electric fans. These are the two large categories, and the third, then we have new categories like kitchen appliances and air coolers. These categories have a higher gross margin than other segments, and this category also requires a lot of initial investments in branding, investments in molds and designs, etc. But the business has been growing very well, and we believe that we will have just like water heaters and fans today, we will also have kitchen appliances and air cooler also will become large categories and with fairly healthy gross margins going forward.
Thank you, sir.
Thank you. The next question is from the line of Renu Bed from IIFL. Please go ahead.
Yeah, hi. Good evening, sir. A few questions that I have. I just wanted to understand, you mentioned on pumps that market has been weak because of significant inventory with you and the channel. One of your peers who reported results yesterday, they mentioned of almost 20-25% growth in pumps for them. So what would be the kind of, as in have we seen some kind of market share loss, or what was our volume growth numbers? Because overall in terms of revenue, I think it was about 3% decline for you for the quarter. So can you help us understand the pump dynamics for you?
So we have fairly high market shares in Kerala and Karnataka, and these two markets have not done well for us. Kerala because of obvious reasons. Basically pump usually does well when there is lower water table, and both Kerala and Karnataka have got more than normal rains for 6 months of this year. So depending upon where each company is strong in terms of geography, they tend to do well. So the same pump business we seem to have grown well in the non-south markets, especially in east and north. So I think it also depends on where you are stronger and what part of your revenue comes from which part of the country.
Okay, right. And in the water heater segment also, as in the way you mentioned that price hikes were not being, have not been yet fully taken through. So just wanted to understand, in some of these ECD categories, these are very segmented markets where you essentially have only one or two key players who have a disproportionately higher market share, and rest of them are more in terms of marginal in terms of share. So pricing would be led by one or two of these market leaders in our view. So haven't you seen some of these players that festive season is around the corner and price hikes or actions have already been there into place? Or you think the market has become so extremely crowded that price hikes have become increasingly difficult and market leadership is actually losing that pricing power?
See, in the case of water heaters, if you look at the first 6 months, we have had almost a 2% decline in gross margins. But I think Q3 is a very large part of the water heater sales. So I think pricing actions will be taken through this season. And there is also other initiatives like new models and new lineups. They've all been launched with better gross margins. So once the mix of the product mix also improves, we should get better overall margins. So I think in the case of water heaters, us along with Racold are the market leaders. So we will, as industry leaders, we will be initiating price increases. I'm sure that this will be taken into the market because you are always going to have a lot of brands competing in the value segment. We don't play there. So I don't think a 2 to 3% price increase is not going to make a huge dent. Our volume growth has been fairly strong for the first 6 months. About 14% volume growth has been happening for water heaters. So that's a pretty good growth, for us as a fairly large player.
Right. And so now if we see already towards the end of October and winters are setting in, so do we already have a timeline when do we want to take this price hike? Because channel will also be stocking the material before the season. So price hikes have been taken or we still need to take a call on that?
No, I think starting Q3 or end of September, the price increases have already been initiated. So they would have gotten into effect in Q3.
And what was the quantum of price increase?
For 3%.
Okay. Right. And regarding the Kerala impact, in one of the previous media interactions, you had also mentioned that you would be having some special incentives or programs where a lot of replacement repair work would also be done for a nominal charge. Have we seen those kind of activities impacting 2Q performance for us? And if at all, what could have been the quantum of that one-time cost related to these extra services that we were giving to our clients?
So although we extended these kind of supports, the availment of those kind of schemes by consumers have not been very, very high. So I think we've had two kinds of hits this quarter. One is some of the retailers are sitting with this inventory that is partially drenched in water and stuff like that. So that's been about about 80 lakhs is what we have initiated for replacement free of cost to retailers as a matter of goodwill. The second is on the service repair. So that has been another cost of about 20-25 lakhs. We've got claims for such free repairs and all that. So all put together, it's been about 1 crore. It's been much lower than what we expected.
It's actually not a big number to that extent.
It is not.
Right. And so one last question. You did mention that I think the previous question you did mention the last 20-25 days, the demand response has been okay. So overall from a demand perspective, from the core real estate driven market plus as well as housing market, how are we looking at those drivers panning up? And the festive season, which was just a week back, how did that close? Did we see a double-digit growth coming back, or probably as an ex of Kerala also, how is the overall market response? Has that improved or it's still muted or soft?
Ex of Kerala. I think ex of Kerala growth is fine. In fact, if you look at the first half, even the first half of this year for us, we have grown as a company at about 12%. In spite of the Kerala issue and the summer performance. The summer categories will not, have carry forward impact into Q3 and Q4. We have not seen any particular change in direction of demand. In fact, if you look at non-South, growth has been, quite decent. We've been witnessing, high double-digit growth in non-South. In South, particularly, the Kerala, Karnataka and Tamil Nadu have been the markets which have been impacted. I think, they have seen, the impact of, what I would say, a strong summer and, subsequently also very heavy rains. particularly, even Karnataka has witnessed very heavy rains in, large parts of Karnataka. So I think, these have been, more, I would say, period related, and we don't see them, carrying forward on a continuing basis. I think otherwise, we are seeing that demand is quite normal as we had planned it would be, and I think it looks fine. No particular issue on demand side at this stage.
Sure. Thank you so much, sir, and all the best.
Thank you.
Thank you. The next question is from the line of Sagar Jetwani from Carvi Portfolio Managers. Please go ahead.
Yeah, hi. Thanks for the opportunity. Sir, can you please throw some light on the progress of relaunching of solar inverter? I mean, also wanted to understand its special features, price and geographies which we will be tapping and margins.
The solar inverters are, yet to be commercialized. So they are in, the revamp of our solar inverter portfolio is, what I would say, still in, commercialization stage. I think Q4 of this year, that is, is when we expect, the solar inverter models to get into market. Yeah?
Okay. Any special features and what will be the price and geographies and margin which we will be?
We will come back on that, along with the launch plan, once, we are ready to, talk about it in the market. Yeah.
Sure. And sir, how has been the response to the premium segments? Like
the smart inverters that we had launched, are working well for us. I think initially the adoption was slow. I think also because it took some time for the inventory to clear out and the new model to hit the market. But lately, what we are observing is closer to 25-30% of our revenue is coming from the smart inverters, so which is a positive phenomena.
Okay. And any new product launches going ahead, sir, in pipeline?
So basically, now, looking ahead, so the water heater season, we've launched a few, new products, but, looking ahead now, it's really the, I think the launch of smart inverters and, the smart solar inverters would be the next set of launches that we will be seeing. Yeah, we are also launching a new, air cooler platform. And that's something that, you will see somewhere towards, the fourth quarter, maybe around January or February this year. So the new platform will be launched. So I think, yeah, these are going to be our, significant. Also, I think, switches, we had one, what I would say, we had, one model or one range. And now, starting this month, the second range is being launched. So, so the expansion of switches portfolio is also something which you will see, this quarter.
Okay. Thanks, sir. All the best.
Thank you.
Thank you. Participants, to ask a question, please press star, then 1. The next question is from the line of Sonali Salgaonkar from Jefferies. Please go ahead.
So thank you for the follow-up opportunity. So my first question is the entire impact of Kerala floods behind us, or there is some part which we could see in Q3 as well?
No, I think as far as the flood impact is concerned, I think we are behind that. There may be some small lingering, economic impact in Kerala, but I think, roughly 4% of the people have been impacted. And out of that, good percentage of them may be, upper middle class who will actually do the reconstruction and rebuilding. So a lot of that should also get, neutralized with the rebuilding and reconstruction. So I don't see a huge impact going forward.
So the largely the impact is behind us, right?
Yes, correct.
Okay. So my second question is in FY18, the brand and sales force revamp exercise which you had undertaken. Are there any updates you could share as to how much traction you've been able to get on this and how is it benefiting us in terms of synergies?
So the brand revamp had, which we had undertaken last year, has, progressed well. I think, what we observe is that, our retail, with the integrated brand identity and the integrated packaging design, which is, consistent across, SKUs and categories. We are finding that, the visibility on the retail shelf has, significantly gone up. Brand perception, has also, significantly enhanced. And I think, the trade has, significantly, what I would say, I have been favorably, inclined to the brand, particularly in non-South also. That's on the brand side. Our overall journey of, revamping the brand has, a couple of other elements also. The second element is that, we wanted to, position the brand as a smarter, smarter brand with solutions, contemporary solutions for the young and emerging Indian consumers. So towards that, we had developed, a few smart products, and there is and we have an agenda in pipeline to extend the smart capability across, our entire product portfolio. So work in that direction is underway, and I think some of the categories, which we had already, developed, were forming part of our, launch campaign, and, a couple of more will come, as we enter newer categories, which, we would, like to share closer to time when, we are ready to go to market with them. There is a third dimension of, the brand repositioning, which is about, extending the brand into more consumer engaging categories. Yeah, I think towards that journey, we have expanded our product portfolio, and, so we have, and we will be expanding our offerings under the kitchen umbrella. We have come in with air coolers and switches, both of which are, more consumer engagement oriented or consumer engaging oriented, yeah, as opposed to being influencer engaging oriented. And, we will also be looking at a few more adjacencies, which, as we make the decisions internally, we will make the market aware. But fundamentally, I think the part of, reshaping our product portfolio so that, we have a much wider range of offering on consumer engaging categories, which come with, higher gross margin. That work is in pipeline, and, will take shape in the coming 1 to 2 years.
Sure, sir. This is helpful. That's it from my side.
Thank you. The next question is from the line of Achal Lohade from JM Financial. Please go ahead.
Yeah, thanks, sir. Just wanted to check the initiative on the distribution side, because we do hear a lot about various companies working on the distribution revamp. So wanted to understand your perspective as to how the sales force...
Yeah, so, as far as we have been concerned, we have, decided to focus initially on the fundamentals and get the fundamentals going on the back end side. So, at the cost of repeating, I just want to take you through what we have done and what is underway. So, we have started with customer service transformation, and, today, we have, what I would say a market leading, customer service practice, within the company. And then, from there, we went into Udaan, and where fundamentally, the first phase of Udaan, we worked on efficiency, which was about, working capital efficiency and procurement efficiency. And, we have, reorganized our function internally within the company to have sharp and strong focus on these two activities. Then, early last year, we started work on, centralizing, quality and, new product development functions. And this journey has progressed well, and, the second phase of Udaan project, has come to a closure about a couple of months back. And now we are embarking on the third phase of the project, where, we will be focusing on further strengthening the R&D and NPD capability within the organization. We believe that it is, as we discussed earlier, we have also worked on the brand. We believe that, once we get the input quality, good, in terms of, our product capabilities, and in terms of, our service capability and brand capability, we will be moving forward in terms of further enhancing our capability on the distribution side. I think as a priority we felt that working on the back end is very, very critical, because we are presently not encountering the kind of challenges that some of our competitors are encountering, given their stage of where they are in the stage of the journey of their respective organizations.
Right. Just the other question I had in terms of the gross margins outlook, the medium-term outlook, what we had earlier kind of pointed out a percentage point improvement every year. Are we on track? And will it be largely driven by the product mix, or is also a function of the price increases?
Yeah, so we are about I think 0.2, maybe about 0.3 to 0.4% up on gross margin, as we speak for the half year. Having said that, we have been significantly impacted in the first half, because of the challenge in stabilizer, which should have been a very important element of our gross margin improvement plan. But the negative impact of that is causing for the overall portfolio gross margin to come down. Yeah, the other piece is that in Q2 we had some commodity write down on copper, as copper prices came off the peak towards the end of Q2, and so these two factors have kind of impacted our gross margin. Yeah. So I think also significant input cost increase have happened across the portfolio simultaneously with these two developments. So the pricing improvements that we have made in the market have helped us to maintain and marginally improve our gross margin, but not allowed us to fully achieve our goal at this stage. But I think to the extent that some of this is related to summer and some of this is related to the copper write down, I believe these are transient impact, and hopefully should not have a should have a more favorable reflection as these factors go out.
Right, and in terms of the south versus non-south margins, how are they behaving? I know you've kind of hinted towards the EBITDA margins, but how are they in terms of the gross margins?
Gross margins, if you look
at gross margin level, I said, like I said before, the difference is not very much.
Okay.
Used to be earlier, it's like about 2% difference nowadays. That's about steady.
Okay.
Last year and this year are not very different.
Understood. And what is the quantum of inventory write down, if you could specify, sir?
On wires, we've had an impact of about 2, maybe 3% on gross margin for the quarter. Yeah.
Sorry.
Which may be about 0.8, 0.9%.
For us, for a total company, 0.8, 0.9%. Yeah.
At company level, 0.8, 0.9% for the quarter, right?
Yes.
That's roughly about 4.5 crores.
Yeah. Yeah.
Okay. All right. And if you could help us with the like-to-like sales growth, have you also, like you said, 10% growth for the quarter on like-to-like basis? If you could also help with respect to product-wise growth, so that one is...
H1 like-to-like growth is about 12%. You would want, stabilizers is a decline, -3.5.
Okay.
All of UPS, that is digital, UPS,
right.
solar, together is about 20.
Okay.
Wires like-to-like is 14.7. Water heaters 15. Fans 21.
Right.
Kitchen 43. Pumps 1.1.
And if you could help with the second quarter as well. Why I'm asking, sir, because on the face of it, the
second quarter, whatever we have reported is what it is.
See, only in the first quarter there was a difference between GS.
The GST.
Yeah. Otherwise, whatever
in the second quarter is given in the presentation, those numbers are the same.
Okay. So basically, there is no adjustment with respect to the Kerala floods for like-to-like sales growth when you mentioned.
No. Like-to-like, we're only adjusting for the GST and all the price deflation.
Okay.
Okay, so that way we have not mentioned, but it's primarily impacted stabilizers and fans, I would say, because there were two products that was going to be sold for Onam, and a high degree of them coming from Kerala. So stabilizer and fan degrowth in Q2 is primarily because of the flood situation. Is what you can infer.
Got it. So basically, when you said 10% like-to-like sales growth in the second quarter, that effectively means you've just on the broad side adjusting for the Kerala impact. Otherwise, whatever presentation we have, the actual growth.
There is a 6% reported growth.
Right.
If the flood hadn't happened, we would have got to 10.
Understood. Great. Can we move on to the next question, please?
Sure, thank you. The next question is from the line of Gaurav Nigam from Catamaran. Please go ahead.
Yeah, thank you, sir, for taking my question. Sir, I wanted to understand the company's overall strategy for the non-South markets. Have we identified something like white spaces in terms of products or geographies which we are trying to fill in? Or are we planning to go head-on against the competition? I just want to understand over a period whatsoever.
So, see, our focus on non-South is fundamentally to grow the business profitably. So, we are controlling and managing both the geography expansion and category expansion so that, margin management objectives are also maintained. And this approach has, although it is giving us more moderate growth, but it is ensuring that, the gross margin difference between South and non-South is narrowing and, narrowing significantly. Yeah. So I think, so our focus, will remain similar. We are getting, good, high double-digit growth in non-South even as we speak. And I think which is reasonable given the balance of input and margin management objectives maintenance, right? So I think we would not be very aggressive about growing non-South, but take a more balanced approach so that we are able to balance investment, profitability, and growth.
Okay. And sir, when we are going to these non-South markets, what is our pitch to the distributor or the retailers to keep our product? Because I'm sure that those distributor and retailer would be keeping the competitor products as well. So what exactly are we offering them? And because if we are going with the same products, and what exactly are we telling them that?
So I think, I think to some degree we are, beyond that stage, where the brand has to, struggle for, making an entry into the, what I would say, into the channel and trade. So I think it's, it's more the retail market is also crowded. Okay. And if you want to grow in a healthy and profitable manner, I think it's more a selection of where you want to do business and who you want to do business with rather than So I think the brand is now quite salient, and expanding channel and trade is not a major challenge at this stage. Yeah. I think our also most of the categories that we are playing in, we have strong and good market positions in Kerala and southern markets, which are indicative of the the capability and ability of our product portfolio to be competitive. So trade is aware and trade realizes this. Fundamentally, I think the trade partners who value so if you look at why people would like to do business with us, I think mostly they I think they are able to realize better return on investment because the penetration of our brand in the marketplace is has significant opportunity to improve. So the price management is better. So the realization for them, is much better compared to competitive brands which might be selling in every adjacent store or every adjacent street. So I think that, our trade partners make better returns compared to competitors because the brand is still underpenetrated in the market. So that's one reason why, they choose to, work with us. The second reason why trade partners choose to work with us is our practice and, way of working. We are a straightforward company, and, our ways of doing business with our trade is, fairly, straightforward, open and transparent. So that's something, they appreciate, working with us, So I think these are two factors, which are helping us to open up the channel and market in non-South.
Okay. And sir, in the non-South market, at what point in time or at what revenue scale do you think that the margins of the South market can be achieved in the non-South market as well?
So I think, definitely in 2 to 3 years, gross margins can be similar. So in fact, they are, quite close now. But, the reason we are not confirming that they are almost there is because, this varies from time to time, quarter to quarter and year to year. Like this year, South is a bit depressed, so maybe the gap will be more narrow. So, but I think, we are almost there. Maybe, a percentage or two, and I think that is something that, we can achieve on gross margin terms. I think on EBITDA terms, it's a different game because, the scale of the southern business is much larger than the non-South. So, there is some way to go there. I think, that would take us at least, I think, 6-7 years. Because, we have to get a similar extraction in non-South as we are getting in South, which actually means that our non-South business has to grow to about 60 to 63% of revenue, which currently today may be, averaging, for the first half, it's averaging around 38%.
Yeah, but our immediate goal should be to get to 50-50.
Yeah. I think we should.
At that point, the EBITDAs of the two should be close enough.
Okay. Sure, sir. Thank you for answering my question, sir. Thank you.
Thank you. Participants, to ask a question, please press star, then 1. Participants, to ask a question, please press star, then 1. As there are no further questions from the participants, I would now like to hand the conference over to Mr. Achal Lohade from JM Financial for closing comments.
Yeah, we would like to thank you everyone for participating during this conference call. Sir, you would like to make any closing comments?
Yeah, thank you Achal and JM Financial for hosting this call, and thank you all for listening.
Thank you very much, sir.
Please subscribe and press the bell icon to never miss another update. Please like, share and comment.